And thanks everybody for joining us for the year-end tax planning webinar. SC&H puts this webinar on every year, but this year it's clear, based on the increased registration, that something might be a little different this year. Just a couple general comments before we dive into some of this material. It's clear to us that the increased interest this year is based on the likelihood that we will, by the end of 2017, have likely the most significant overhaul of the U.S. tax code in more than 30 years. As a result, we're going to focus most of our time on a discussion of the provisions in both the House and Senate bills. We will present some planning ideas that may present themselves as a result of the tax bill, and at the end and throughout, we will also touch on traditional tax planning strategies that would apply whether or not the bill becomes law. However, due to the volume of material that we need to cover today, we're likely not going to get into as much detail about some of the strategies as we might otherwise. We encourage you to reach out to your advisor on any questions that we're not able to answer today. We're going to move relatively quickly, so let's get started. The disclaimer is a little bit more important this year than ever. A lot of what we're talking about is conjecture or opinion based on where we think this bill is headed, so take that for what it's worth. Let me get the next slide. Okay, so today the format is a discussion initially on individual tax changes. My name is Greg Horning. I'm a founding director at SC&H. Amanda Wilhelm is going to join me in presenting on individual tax planning and individual tax impacts of the bill. After we've wrapped up, which is likely around 1 o'clock, Angelo, Poletis, and Justin Huovinen will follow up on a presentation regarding business tax matters, and then finally, Bob Dillon will be talking about some international tax impacts. So, as we move into individual tax planning, everybody should be aware that both the House and Senate have passed their own version of the tax bill and are now entering into the conference phase where both houses will negotiate language that will appear in the final bill. Every intent of Congress is to move quickly on this, and just within the last hour or so, we're starting to see some statements that there's a hope or a possibility anyway that the conference process could move relatively quickly, and there's a possibility that you may even see votes on a final bill released as early as Monday, and votes in the House and in the Senate as early as Wednesday or Thursday of next week. But in any case, for political reasons, the Republicans are trying to push this to fruition and to signature by President Trump no later than December 22nd. So with that, let's talk a little bit about the individual tax provisions. So as we move through these slides, we're going to highlight the differences in the provisions between the House and Senate versions of the bill. It's important to note that what we expect in the final version of the bill is likely to be most closely follow the Senate version. Although we do expect that the House will require some concessions as the conference process proceeds. So on this slide, we're looking at the individual income tax rates and brackets that would apply under the Senate version of the bill. The Senate version provides for 7 tiered rates, with the highest rate of 38.5%, which would apply to taxable incomes in excess of $1 million. On the next slide. On the individual rates under the House bill, though, the House proposes only 4 rates, Again, they would maintain the highest rate at 39.6%, where it is today, but apply that for married filing joint taxpayers on incomes over $1 million as well. Generally speaking, rates on similar levels of income under both versions are lower than they are under current law. You'll see, I think when Joint Committee on Taxation scored these bills, they indicated that all taxpayers at all levels, on average, should expect lower tax bills. Now, that doesn't mean that all taxpayers will see decline in taxes. There will be winners and losers as a result of many of the other changes to deductions and taxation of different types of income. Again, we look for the final bill to look with respect to income tax rates more like the Senate bill as it currently stands. So with respect, one of the big provisions with respect to individuals is the elimination of personal exemptions and roughly doubling of standard deductions. So these changes, coupled with the elimination of certain itemized deductions that we'll talk about in a little bit, would mean that most taxpayers would no longer itemize their deductions on their tax returns. Today, the estimate is that about 30% of Americans itemize their deductions. Under the bill, the experts that I've read indicate that they expect that under the bill, as currently proposed, only about 6% of taxpayers would itemize deductions in the future. So for CPE purposes, this is our first polling question. I'll read this and then give you a few seconds to register your response. True or false? Both the House and Senate bills repeal personal exemptions for individuals. Go ahead and register your answer, please. Okay, it looks like most have their answers in, and the answer to this is true. Both House and Senate do repeal the personal exemption, but double the standard deduction. So as we move into the itemized deductions I referenced earlier, on the Senate bill, the most significant changes to itemized deductions are as follows. First of all, the Senate bill would eliminate the deductibility of all state and local income taxes. It would eliminate or limit the deduction for real estate taxes to a maximum of $10,000. It would eliminate the deductibility of interest on home equity loans entirely. And while it would allow you to continue to deduct mortgage interest on home acquisition debt as under current rules. And it would eliminate all miscellaneous itemized deductions. Importantly, another difference that we'll see when we flip to the House side, medical expenses would remain deductible, and the threshold for deducting medical expenses would drop back down to 7.5%. And charity, the limit on deducting charity would rise from 50% to 60% of adjusted gross income. Under the House bill, it's similar, but there are a couple of differences. First, interest on home mortgages would be deductible only on debt on acquisition debt, only up to $500,000, and that limitation would apply for homes acquired or acquisition debt occurring after November 2 of 2017. There'd be a grandfathering provision for mortgages in existence prior to that date. And under the House bill, the other major difference is that medical expense deductions would be eliminated in their entirety. Just a comment on the mortgage interest limitation. Our expectation here would be that there'd be some kind of a negotiation. We may end up on a debt limit of $700,000 to $800,000 where the interest would be deductible, but in any case, interest on home equity loans would no longer be deductible. When we think about the increased standard deduction and the elimination of many of the itemized deductions, there's an extremely important impact on our planning, our year-end planning strategies, and for now and going forward. A couple of strategies that might make sense to think about as if these provisions come into play. One is a traditional planning strategy that we use regularly, and that is accelerating payments of state taxes into 2017. A little bit more important this year, since if the bills are successful, those state income taxes would not be deductible next year at all. Also, I expect that we will see a huge increase in charitable giving in December, much larger than we've ever seen in the past, as taxpayers accelerate charitable giving to take advantage of a year when they will be itemizing and when they might not be itemizing in the future. So to do that, there are ways, I'm not going to have time to go into great detail, but there are ways that you can fund your charitable giving this year using a donor-advised fund. Take the full deduction, but fund it with a dollar amount large enough to cover your planned giving over many years into the future. So think about donor-advised funds. Call us if you have questions on how that strategy might work. Also, I would suggest you might think about, if the bill is successful, if you have outstanding pledges on capital campaigns or otherwise, you might choose to accelerate and pay off those pledges in 2017. Also, so going forward, this concept, many of you may be aware of the concept of bunching deductions. So bunching deductions could become a very popular strategy under the bill. So if we think about an example where, let's say a taxpayer or a couple has maybe $10,000 of mortgage interest and $5,000 of real estate taxes on an annual basis. And if they regularly contribute $10,000 to charity, that would be a total of $25,000 in total itemized deductions. Well, under the bill, the standard deductions would be $24,000. So whether they give that money to charity or not, they're going to get a $24,000 deduction. They're only getting a benefit for essentially a tax benefit for $1,000 worth of that charity. So what in that case, and this would apply to many, many taxpayers, in that case, what we would suggest is that the taxpayer plan to itemize deductions maybe only 3 or 4, every third, fourth, or fifth year or so. In that, what we would do is we'd use a donor-advised fund that in 1 year, when you do plan to itemize deductions, with enough money to cover your giving over the ensuing 4 or 5 years. Take that full deduction this year. You may even be able to bunch, delay and play with the timing of your real estate tax payments and so forth, so that you maximize your itemized deductions in 1 year, and then in those ensuing years, when you are not generating any charitable contributions that are deductible, you would not be itemizing. So in my example, if all they have in a year is $10,000 of mortgage interest and maybe $5,000 or even less of real estate taxes, they would still get a $24,000 deduction, essentially generating $9,000 of free deductions, if you will. Just one other comment on charity. As normal, as we've espoused in the past, we encourage our clients for any significant charitable giving that they consider funding those gifts with appreciated securities, which allow them to take a full deduction for the value of the securities donated without ever having to pay tax on the capital gain on that security. And this is different. Just a reminder, there is no prohibition after donating a security to charity. There's no prohibition of going back into your account and just repurchasing that security right back, as there would be if you were capturing a loss. So at this point, I'm going to turn the mic over to Amanda Wilhelm to talk about some other impacts of the bill on charitable giving, or on individual taxpayers.
Thanks, Greg, and thank you everyone for joining us today. One quick comment I wanted to make before we talk about the above the line deductions. I think we were talking about this morning. The item about the $10,000 property tax deduction, they're still kind of, I think, kicking around in Congress that they may just allow that to be a $10,000 deduction overall. So maybe it's partially property tax, maybe it's partially state and local. They haven't scored it yet, they haven't come with anything definitive, but I know that that is still in play. So maybe there is some hope for a little bit of state and local tax deduction. So anyway, let's jump in and talk about some of our above the line deductions. So as you will see from the slide, the House proposal seeks to eliminate the above the line deductions that we have outlined above. However, the Senate only agrees on elimination of the moving expense deduction and looks to preserve the others in their current form with an increase to the educator expense deduction. They're looking to double that. The House bill has allowed caveats for the alimony and moving expense deduction, which I've also noted on the slides. So our advice here, planning, is if you are in the process of finalizing a divorce that includes alimony, you may want to discuss this sooner rather than later with your attorney to see what can be agreed upon before year end. But other than that, there's not, unless you're trying to prepay some student loan and get some interest deductions. But again, that gets limited based on your adjusted gross income. Next is our individual tax credits. Touching briefly on the impact of some of these various tax credits, the adoption credit and dependent care credits will be preserved in their current form. This minor, the electric vehicle credit will be eliminated under the House bill, but will be preserved under the Senate bill. The main topic of conversation for a lot of people has been the child tax credit, and it's been a focus for many. Under the House bill, the child tax credit would increase to $1,600 from its current $1,000 level, and it would be expanded to children under the age of 17. It would allow for a $300 credit for non-child dependents. They are currently calling this a family flexibility credit, and this credit, the $300 credit, it's set to sunset on 12/31/22. The Senate's bill would temporarily increase the child tax credit to $2,000, of which $1,000 would be refundable. It would expand it to children under the age of 18, and then it would allow a $500 credit for non-child dependents. The Senate's proposal would be effective for tax years after 12/31/17, but it would expire after 12/31/2025, and it would revert back to its current status. So it would come back to the rules that are in effect as of the 2017 tax year. Seems like a lot of the individual items that we're talking about, especially in the Senate's bill, are set to sunset after, or expire, excuse me, after 12/31/2025. That leads us to our next polling question. So true or false, both the House and Senate bills eliminate the state and local income tax deduction for individuals. Okay, and it looks like our answers came in, and as of right now, that is true. Both bills are looking to eliminate the state and local income tax deduction for individuals. Right now would be capped at a $10,000 deduction for property taxes, which is real estate tax. That then brings us to talking about the education incentives and credits. And I tried to provide a lot of detail up here for referral, but in regards to the education credits, we currently have the American Opportunity Tax Credit, the Hope Scholarship Credit, and the Lifetime Learning Credit. The House bill is looking to consolidate the American and Lifetime credits into a more robust credit and eliminate the Hope credit altogether. The Senate bill right now makes no changes to the current education credits. They're leaving things as they are. The House bill is looking to repeal the student loan interest deduction, but it would be retained by the Senate's bill. Neither bill is looking to revive the tuition and fees deduction, which expired after 12/31/16. There had been some talk of that, but that's going away as well. One other item to speak about here is the Senate's bill is looking to, if you have forgiveness of student loan debts due to death or disability, they're not making you bring that into and recognize income on that. Next, I wanted to just touch briefly about the proposed changes to the 529 plans, which I'm sure is of interest to a lot of our clients. The biggest change here, proposed change, excuse me, under both bills is allowing taxpayers to utilize these funds for elementary and high school expenses. Most of us know 529 plans were, as they said, college savings plans. They were used for higher education. The proposed limit, it's an annual limit of $10,000 per child under both bills. The Senate bill is allowing this even for homeschooling expenses, which is interesting. There's a couple other little minor things that may be coming through. Some have been nixed, some have not. Some in the Senate bill, they're saying you could possibly have created a 529 plan and name an unborn child. We think that's been nixed, but it's like odd things that are still floating around out there that have not been nailed down. Now hand it back over to Greg to pick up to talk about the gain exclusion on principal residences.
Thanks, Amanda. In both versions of the bill, there are significant changes for individuals to have the ability to avoid tax on a gain on the sale of a primary residence. Generally speaking, in order to qualify for the exclusion under the bill, you would need to use your home as a, I'm sorry, I forgot to flip the slide. So generally speaking, in order to qualify for the exclusion, you need to use the home as your primary residence for at least 5 years. So that's a 5 out of 8 year test. Upon sale, you would look back over the last 8 years. Was it your primary residence for 5 of those 8? And if so, then you'd qualify for the exclusion. $250,000 gain exclusion for an individual, $500,000 exclusion for a married filing joint return. However, there's also that in the House bill, there's a provision that would phase out the benefit of this exclusion. So for high income taxpayers, married couples over $500,000 in AGI, that exclusion would be phased out. So for anybody out there who might be thinking about moving in the near future and has a substantial gain built up in their house, you should be watching this relatively closely. Some other provisions included in the Senate bill. Capital gains rates don't change. The levels at which the various 0, 15, 20% capital gains rates apply would be indexed and matched up to the new rate brackets. But with respect to capital gains, there is a provision in the Senate bill that would require sales of securities to be done on a first in, first out basis. And so this is obviously a revenue raiser. This means generally, in most cases, that you would have to sell, when you sold securities, unlike today, you would be forced to sell your oldest shares first, which are likely to be your lowest cost shares. Currently, under current law, you can specifically identify which lot is sold. So that would be a potentially significant change. It's, depending on how the language is written around this, we expect that there might be some planning opportunities to skirt around this. And one example would be, we expect it to be applied on a taxpayer basis, an individual taxpayer basis. So let's say you own shares of a security that were acquired at several points in time over the last 30 years. You could transfer the oldest low-cost basis shares potentially to your spouse and sell the higher cost shares, oldest but higher cost shares out of your account. Also, combining, it may make sense to combine the harvesting of gains out of your portfolio or reduction in holdings with charitable giving, and potentially use those oldest shares to fund your charitable giving. The Senate bill has a provision that would limit the availability of large business losses to offset other income. So business losses likely would be pass-through or Schedule C losses that exceed $500,000. Only $500,000 of a loss in that of that type would be available to be used to offset other compensation or portfolio income. That provision is not in the House bill, so that's another area that they will have to work through. Importantly, AMT. So we were surprised last week when the Senate bill did not repeal AMT, but instead raised the exemption limits on alternative minimum tax. So under the Senate bill, AMT would be retained, but with a higher exemption. So based on that exemption, we expect, based on our calculations, we expect that very few taxpayers would actually pay AMT. Those that would be in higher, at higher income levels than they are today. And also, it's likely that in order to fall into AMT, you would likely need to have some other type of adjustment that differs between regular and AMT tax treatment. For example, you've exercised incentive stock options, or you have substantial depreciation calculation differences between your regular tax calculation and your AMT calculation. Under the House bill, the House would just repeal AMT in its entirety, and as I said, does not include the business loss limitation. There's no, in either bill, there's no real significant changes to retirement accounts or the net investment income tax that applies on investment income for higher income taxpayers. Those both stay in place. The piece limitation, that's the phase out of itemized deductions, where you're for higher income taxpayers, the 3% phase out, that would be repealed under both bills. So that's going to bring us to our next polling question, which is true or false. Both the House and Senate bills preserve the charitable contribution deduction for individuals. Give you a minute to register your responses. So the answer to this question is true. Both bills do preserve charitable contributions deductions, although whether, the planning will change, right? With a higher standard deduction, many individuals, if they're not careful, won't get the full benefit from a tax standpoint for their charitable giving. All right, so I guess now we're going to move on, give it back to Amanda to talk a little bit about estate and gift tax.
Thanks, Greg. I just want to give a quick update on the estate and gift tax side. It's been kicked around been going back and forth for many years now. The debate about the repeal, trying to repeal the estate tax. The House bill is calling for first doubling for a current federal exemption, taking it from its $5.5 million per individual to $11 million, with a total estate and GST tax repeal in 2024. So the House is still pushing on the full repeal of the estate and the generation skipping transfer tax. However, the Senate bill, it calls for keeping the estate tax. It wants to keep it in place. And again, as Greg had mentioned, they're saying that whatever the final bill looks like, it's probably going to follow the Senate's proposals. The Senate, they're calling for keeping the estate tax, but following the House's lead of doubling the current exemption. Under both bills, it would preserve the gift tax regime with an annual exclusion of $15,000 in 2018. It's been held at $14,000 for the past couple of years, but for 2018, you'll be able to do an annual gift to as many as you like, individuals as you like, at $15,000 without incurring a gift tax or a filing requirement. Both bills preserve the stepped-up basis on assets inherited. What the stepped-up basis is, that's the fair market value of date of death. That would be the new basis for the beneficiary that inherits those assets. Just one thing to keep in mind here, even if whether it's repealed or if it is held in play for Maryland residents, this is going to be interesting because the Maryland estate tax exemption was finally going to be in line with the Fed again in 2019. Obviously, that was at the 5.5 or 5.6 or so million that it would be at. Obviously, the Fed goes about doubling this. I don't know what Maryland's going to do, so that's something that we'll have to keep in mind again. Just a quick discussion on international. I just want to touch on this briefly on this aspect for individuals, as Bob Dillon's going to be speaking on this topic later in the webinar. But right now, both bills are proposing an immediate taxation of accumulated earnings and profits held within a foreign corporation that's owned by an individual taxpayer. And this is regardless of whether or not distributions have been made. The difference between each bill is who's going to be subject to this new rule. Either it's those bills that have an ownership percentage or the type of corporation, and we'll have to wait to see where they land on this. In short, it does not appear that either bill will be making changes to go to a territorial tax system for individuals. I think this has been a lot of confusion. I think some of the reporting that has been done on this, just because this part of the bill is, while it's all a bit confusing and convoluted, the international piece definitely is, and I think there may be some confusion here, but this piece I believe is still in the works, and the proposals that are currently out there they're just very contradictory and hard to understand. I believe that worldwide taxation is proposed to remain in place for individuals. What this means is right now, under our current system, U.S. citizens and resident aliens are taxed on their worldwide income, regardless of where they live and work. So that would be a big change if we made a shift, but I don't see anything about that right now. One other item to mention, the informational reporting currently in place for foreign bank accounts and certain other specified foreign assets is currently going to remain in place. So we're still going to have to do the FBARs and the reporting about foreign assets held, and those thresholds have stayed the same. So if you have any questions about that, have acquired any new assets, foreign assets or any type of foreign holdings this year, you definitely want to speak with your advisor, let them know about that, because those rules have not changed. now going to hand it back over to Greg. We just want to touch, it seems like we have a little bit of time. We're going to touch briefly on just the traditional planning strategies, and we'll weave that back into the current bill, but try to leave everyone with some items to consider for year end.
Thanks, Amanda. So back to, here we go. Back to the more traditional tax planning, that these are ideas that may come into play for you regardless of whether this bill comes to pass. So a couple quick things on this. Every year we'll hit on saving for retirement. On the screen we show the 2017 401k and IRA contribution limits for under age 50 and those age 50 and older. It's typically a good idea to be maximizing your funding. With respect to IRAs, the strategy can be unique to each taxpayer, whether you're better off funding a traditional IRA or a Roth IRA, and whether you might be considering conversion of traditional to Roth. So those are all conversations that or thoughts that should be considered before 12/31. For those individuals that are covered by a high deductible health insurance plan, you have the ability to make tax deductible contributions to a health savings account. Here again, the limits for individual and family coverage are shown on this slide. You have, with respect to HSA contributions, you actually have until April 15th or until the due date of your tax return in order to make those, finish funding those. So you have some time to play with that. But as you're filing your return, if you're looking for additional deductions and haven't fully funded those HSAs, that might be an opportunity. AMT, obviously, every year we're worried about where we stand and how AMT impacts your personal tax return should be considered in virtually any kind of planning that you're doing, particularly in the areas of state income taxes and timing strategies for exercising incentive stock options and the like. And for most taxpayers, and I don't think this year is any different, whether the bill passes or not, for most taxpayers, it's preferred that we defer income and accelerate deductions. So that might not be true if you're, for some reason, having a down income year where your tax brackets are lower, but you're expected to rebound next year. So opportunities to accelerate deductions back, state income taxes, charity, if you have outstanding professional fees for deductible type items, those kinds of things. Now, and with cash basis businesses, if you have a Schedule C on your personal return, then obviously we'd be looking to pay all your bills before year end and delay the receipt of any revenue that you have control, that you might be able to have an impact on. With respect to capital gains, this year is likely to be a very significant year for many taxpayers based on the market conditions. So we would expect that there might be an opportunity. You might have to look pretty hard, but you ought to be looking at your portfolio for any opportunities where you might be able to capture capital losses where you can offset realized gains in your portfolio. And again, Roth conversions, I think I touched on this briefly. We do a great deal of planning with clients who are either temporarily in a lower income tax bracket or in many cases, individuals who have retired early or retired before age 70 and a half, in many cases there's an opportunity where they are temporarily in a lower tax bracket. Their required minimum distributions from their IRAs and 401ks have not kicked in yet. So if we find an opportunity to take advantage of lower rates for one or several years, we may do partial Roth conversions to voluntarily pay tax at a lower rate and soak up the benefit of those rates, which also has the effect down the road of minimizing future required minimum distributions from those IRAs, because Roth IRAs are not subject to those required minimum distribution rules. So another item, and I'm going to be wrapping up here in just a minute. So if there are questions that on individual taxation that you'd like to register, let's get them in now so that we can address them before we turn it over to Angelo and Justin on the business tax matters. The last significant item on tax planning that I'd like to talk about is a little bit more on charity. Remember, I mentioned using appreciated securities there. We're looking for likely the lowest cost basis security in your portfolio is the best security to be considered as a candidate for charitable giving. The benefit is a full deduction for the value of the stock that is given to charity, and the avoidance of any taxation on the capital gain. And again, as I mentioned earlier, you can buy that stock right back if you want to continue to own it. Donor advised funds, I'll give a little bit more on this here. Donor advised funds allow you to contribute, and you can contribute appreciated securities to a donor advised fund. When you contribute appreciated securities, whether it be directly to a charity or to a donor advised fund, the adjusted gross income limitation is 30% of your adjusted gross income is the maximum that you're allowed to, maximum deduction that you're allowed to offset. But in most cases, most taxpayers aren't interested in going over that level anyway, and if they do, any additional contribution is carried over to future years. But using the donor advised fund allows you to, in a year when you have substantially higher income, so maybe there's a sale of a business or a large capital gain from the sale of a piece of property, or it could be stock option income, whatever. If you're temporarily in a very high tax bracket, you want to accelerate charitable giving and fund many years or several years of future giving, but do that before year end, you can easily set up a donor advised fund to get that, to accomplish that. A reminder on non-cash charity. So with respect to non-cash charitable contributions, these are most typically, household goods, clothing that you can, you can take at delivery directly to Goodwill and other typical organizations. Those are deductible up to the fair market value. If the value that you're donating exceeds $5,000, then we need an appraisal. So be cognizant of that. And just a little plug here for the Maryland Community Investment Tax Credit. For many of our clients in this area or in this region, it's very possible that the charities that you support may be part of this Community Investment Tax Credit program. I encourage you to search CITC, Maryland CITC. There's a map in there. You can look at it by county. This program allows you to receive a Maryland tax credit on your personal return for up to 50% of the amount given to a charity for an approved program. That's on top of the savings for on your federal and state income tax return for the value of the contribution. So it's actually mathematically possible that if you use appreciated securities to fund a gift to a program that qualifies for the community investment tax credit, there's actually a mathematical possibility that you could technically make money giving to charity if the gain on the security was large enough and you were in a high enough tax bracket. Okay, with that, I'm going to pause while we accumulate some questions, and I'll be. Oh, I'm sorry. We have one more polling question that we need to get through. Both the House and Senate bills are limiting the property tax deduction to, is it $50,000, $20,000, $10,000, or $1? I'll give you a minute to register those answers. So the answer on this question is C, $10,000. We do have a few questions that have come in. One is, does the reduction in tax brackets offset the elimination of the state and local tax deduction? Was that it? Yeah, so likely for most taxpayers it will. But again, this is an area, there's two things here. One, it's an area where I believe there will be winners and losers. And number two, there's a distinct possibility that the brackets and the rates could change in the final bill. There's talk in some of the things that the Congress is looking to achieve. There's a lot of pressure on increasing the child tax credit, and I think actually last night there was a vote to require, I'm not sure if it was the House or Senate conferees but requiring them to increase or work to increase the child tax credit. They would need to find money to pay for that because that's an expensive provision. So one of the options would be for the tax rate on the highest income taxpayers in the Senate bill to jump back up to 39.6%. However, while the rates are are similar to current law under the Senate bill, the ranges of income to which they apply are higher, and which means that it's going to take longer for most taxpayers to hit those higher brackets. And so my expectation would be that, it's a long-winded way of saying, my expectation would be yes, that the combination of the more favorable rate brackets and the elimination or the increase in standard deduction would more than offset for the majority, but not for every taxpayer. So let's see, there's another question. What happens to interest loans on investment property or HELOC for investment property, subject to same limits if investment property is passed through it? So, so here I'm assuming that this is a rental kind of, so if you have a rental property and have a mortgage on that, with respect to real estate held for investment, no, I'm not aware of any new provisions that would limit deductibility of interest other than the provisions that are already in place, passive loss limitations and so forth. Well, income, here's a good one. I have not actually seen this spelled out anywhere, but the question is, will state income tax refunds still be taxable in 2018? Well, I will, I haven't seen it written, but absolutely any, if you took a deduction on your 2017 or earlier tax return, I'm very sure that in 2018, you'll pay tax on that refund. However, for refunds, state income tax refunds attributable to years 2018 or later, when you don't get the benefit of the deduction, I do not believe those refunds would be taxable. Let's see. Please cover the exclusion phase out on the sale of the residence house versus the Senate. Okay, so the Senate does not have a phase out on the home sale exclusion. All right, so under the Senate bill, the rule would be identical to what it is today, but instead of requiring you to use it as your primary residence for 2 out of 5 years, you would be required to use it as your primary residence for 5 out of 8 years. So there is no phase out in the Senate bill or in the Senate version. However, in the House version, once you hit for a single taxpayer, single head of household, once you hit $250,000 in AGI and adjusted gross income, and for a married taxpayer, once you hit $500,000 of AGI, that phase out would be dollar for dollar. So, an example, if I have a $500,000 gain on the sale of a property, I'm a married couple filing jointly, and I don't qualify, well, whether I qualify for and I do qualify for the exclusion under the 5 of 8 rule, if my AGI is over $1 million, I would be completely phased out under the House bill. What else do we have? We are an independent school. Are there any thoughts on discussion on the potential that a new tax bill will make tuition remission a taxable benefit? So I'm not aware of any provision in this area. I haven't seen anything on that. So to my knowledge, no.
We have the opportunity for 529
and just money to be used for.
Yeah, you would have, and
elementary and
there might be a little bit of a benefit there. You'd have
people can use that money now if they want to.
Right.
I can address the next question.
So the one question is, any comments on taxation of pass-through income? We intentionally left that out. That's going to be covered during the business taxation section of the presentation, which is going to follow this.
One last question we have: if the worldwide taxation system stays in place, is the foreign earned income exclusion expected to survive? Right now, based on what we know, yes, none of those rules are changing. So if you are an individual living and working abroad, and you are taking advantage and able to use the foreign earned income exclusion, the foreign housing exclusion, these are items, tax benefits that are in place for individuals who are living and earning income abroad, because we are taxed on our worldwide income. You're able to exclude a portion of your income. That amount is adjusted for inflation each year. Right now, under the current proposals, they are not addressing those. So right now, they're going to stay in place. I'm definitely monitoring that. We have a lot of clients overseas that are in this situation. So we'll keep an eye on that and update you accordingly.
So it looks like the individual that asked the question about tuition for tuition remission is saying, I'm referring to schools that allow their employees' children to attend a school they work at a discounted rate.
Oh.
Again, I'm not aware of any provision in this bill that would do that. There were in the original House bill, prior to the House vote, there were provisions on several compensation items, including deferred compensation and other that would have dramatically changed the ability of companies to, companies to incent their employees with the use of equity, and also would have made it difficult for individuals who might currently be able to participate in a deferred compensation plan where they elect to defer income. Those would have been severely cut back under that original version of the bill. But I believe all of that, with the exception of a provision that actually appears more favorable, all those provisions were deleted. There's an opportunity for certain non-publicly traded companies, I think, to use non-qualified stock options, and employee may be able to make an election to defer income for up to 5 years on that otherwise under current law would have been taxable immediately upon exercise. So that's the only compensation related provision that I'm aware of that's currently in the bill.